All right, let's jump right in. Today, we're breaking down a really fascinating investment idea. And it's a bit of a contrarian take. It basically says if you believe in the future of technology, maybe you shouldn't be buying tech stocks at all. Instead, you should buy the buildings where the tech wizards actually live.
And this quote, this one line, it just says it all, doesn't it? It's such a great hook because it takes this wild, often crazy world of tech stocks and connects it to something you can actually touch, bricks and mortar. The whole bet, the whole thesis is really simple, that there's a direct line between those huge big tech paychecks and what people are willing to pay in rent.
So who's actually doing this? Well, there's one company that has really made this their entire game plan. It's called Essex Property Trust, ticker symbol ESS. And these guys have basically built their whole business around being the tech landlord. They focus almost all of their energy on the West Coast's biggest innovation hubs. They're what's known as a REIT.
And for anyone who's maybe not super familiar with the term, a REIT, that's R-E-I-T, is basically a company that lets you invest in a whole portfolio of properties, kind of like a mutual fund, but for real estate. The really important thing to remember about REITs is they have to, by law, pay out most of their taxable income to shareholders as dividends, which, as you can imagine, makes them pretty popular if you're looking for investment income.
Okay, so let's dig into the first piece of this puzzle. What exactly makes this bet on Silicon Valley real estate so powerful? Well, it all comes down to the economic engine that's running there. I mean, think about it. Silicon Valley isn't just some random spot on a map, right? It's the global epicenter for creating wealth. You've got this insane concentration of the biggest companies on the planet. We're talking Apple, Google, Meta, Tesla, you name it, all packed into one small region. And that creates this constant, almost perpetual motion machine of job creation, and it's all greased by this endless fire hose of venture capital money. And what does that engine spit out? Well, it spits out some seriously high-paying jobs. We're talking median salaries for tech pros that can easily blow past $200,000 a year. And get this, that's often before you even factor in things like bonuses or stock options. So here's the key takeaway. All that money, that incredible income, gives tenants the firepower to pay for premium apartments. And they do. But look, sky-high demand is really only half of the equation. You have to look at the other side, and that's where this gets really interesting. The other piece of the puzzle is the incredibly tight supply of housing. It acts like a protective moat around the landlords. And this right here, this lays out the core tension perfectly. It's like a classic economics of 101 case study on steroids. On one side, you've got this tsunami of demand, all these high-paid people flooding in for jobs. But on the other side, a brick wall of supply constraints. I mean, the Bay Area is literally stuck between the ocean and mountains. You can't just build outward. Then you layer on some of the strictest zoning laws in the country, plus a healthy dose of not in my backyard sentiment. So what happens? This massive imbalance gives the people who already own the buildings incredible pricing power. Okay, so that's the big idea, the theory behind it all. But how does it actually work in the real world? Let's look at how a company like Essex puts this plan into action. And they are laser-focused. They're not just buying any old apartment building. They go after high-quality Class A and B properties that are strategically placed right next to the big tech campuses or major transit hubs. Everything is designed to appeal directly to their customer, the young tech professional. So you'll see modern amenities, co-working spaces right in the building, state-of-the-art gyms, everything that fits that specific lifestyle. And this chart really drives home just how focused they are. They are not diversified across the entire U.S. at all. I mean, look at this. Their portfolio is overwhelmingly concentrated in just 3 key West Coast tech markets. You've got the Bay Area and Southern California making up almost all of it, with Seattle as their third major hub. This isn't a broad bet on U.S. real estate. It is a very, very specific bet on tech hubs. Okay, but it can't all be sunshine and roses, right? No strategy is foolproof. So, to be fair, we have to look at the other side of the coin. What are the potential cracks in this foundation? What could go wrong for the tech landlord? Well, the big one, the elephant in the room, is this. What happens when that tech engine stalls out? Because let's be honest, the tech industry goes through cycles. It's not a straight line up. We've all seen the headlines about layoffs. A real slowdown could hit rental demand hard and make it a lot tougher for landlords to keep raising those rents. And then, of course, there's the remote work question. This is a huge one. If you're a software engineer and you can do your job from anywhere, do you really need to pay $5,000 a month to live in a tiny apartment in Silicon Valley? Could this whole work from anywhere trend finally break the gravitational pull of these tech hubs and just completely change the game for landlords?
And last but definitely not least, you have to talk about politics. I mean, trying to be a landlord in California or Seattle, that's a whole other level. These are some of the most pro-tenant, heavily regulated markets in the entire country. You're dealing with things like rent control, which can put a hard ceiling on how much profit a landlord can make. But for every risk, there's usually a counter-argument, right? And this table sums it up nicely. So yeah, tech cyclicality, that's a risk. But the counterpoint is that historically, these tech hubs have always bounced back, and usually stronger than before. Remote work, a huge deal, for sure. But a lot of companies are pushing for hybrid models, and there's still a powerful pull to be physically in the ecosystem for your career. And then the regulation piece. This one's kind of fascinating. While rent control can cap your upside, it can also scare away new developers, which means less new competition for the landlords who are already there. It's a double-edged sword.
So let's just recap the whole thesis step by step. It's actually pretty simple. Step 1, the tech economy creates an unbelievable amount of wealth. Step 2, that wealth turns into high-paying jobs, which drives up demand for places to live. Step 3, that demand smacks right into a wall of super limited housing supply, which pushes rents through the roof. And finally, step 4, a company like Essex is perfectly positioned to just sit there and collect that value.
So at the end of the day, what's the big pitch here? It's this. Investing in a company like Essex is a way to ride the wave of the tech boom, but without the stomach-turning volatility of trying to pick the winning tech stock. You're not betting on one company. You're betting on the entire ecosystem through a much more stable asset, real estate. And that really leaves us with the big question you have to ask yourself. Is this whole thing the ultimate backdoor investment into tech? A smart way to get the growth with more stability? Or is it just a super concentrated, super risky bet on the future of a few very specific, very expensive zip codes? I think the answer really boils down to how much you believe in the long-term, unstoppable power of Silicon Valley.